difficulties. Plus, I'm taking care of my mom, and I got to tell you, life changes as life changes. How about that? So, anyways, you're here right now to learn lesson number 5 on what we're looking to qualify people for a home mortgage. So, a lot of people don't know anything when it comes to qualifying for a home mortgage. And the interesting thing is most people don't realize that the loan officer is there to help you. The loan officer gets paid when your loan closes. So we're here to help you. So we need you to tell us all the truth so that we can look at everything and figure out which loan program is the best for you. So lesson number 1, briefly, lesson number 1 said, talk to a loan officer, get pre-approved, not pre-qualified. Lesson number 2 said, hello, how you doing? Thanks for coming back. Lesson number 2 said, okay, now that I talked to a loan officer, the loan officer wants to know about my credit. And lesson number 2 told you, go ahead and get your free credit report. Every year you can get an annual credit report. I talked to my bio mom. That's cool. Call me. Let me know how it went. So lesson number 2 talked about, get your free credit report. All you have to do is go to annualcreditreport.com with all 3 repositories and look at your credit and see what it says. And if you have any late payments or any derogatory information, you should challenge it, and then that will bring up your score. So the next thing is how much your income, how much of the income do we count? So lesson number 3 was, so I'm trying to read people's comments at the same time I'm talking to you. So it's totally throwing me off. So I'm not going to be listening or looking at the comments anymore because this is important stuff on how to qualify for your mortgage. This is all I'm here for right now. Okay. So the next thing is we look at your income. Now, to look at your income, you should have your income in front of you right now so that you can write it down. If you have a paycheck in front of you, you want to look at the date that you're paid through, and you want to look at the year to date. So the year to date and what date you're paid through. Okay. Because what they're going to do is they're going to take, like right now, you would be paid through most likely if you got a paycheck on 7/1, then you were paid for a full 6 months. So you look at the year to date on your 7/1 paycheck, and it was paid through the end of June, and you divide it by 6, and that will tell you what your monthly income is. Now, if you're on salary, you should know your monthly income, but a lot of people have bonuses, overtime, and commission. So we have to look at that separately, okay? Because we have to look at the history of that for 2 years. So we talked about income on lesson number 3. On lesson number 4, we talked about debt. How much debt do you have? And the best thing that I could do for my clients is I look and see how much longer their debt is going to be. Because if your debt is less than 10 months and it's a car payment, we don't have to count it against you. But if it's a car lease, that doesn't work that way because you're going to turn in the lease and get another lease. So the only other thing you can do is wait till you turn in the lease and then prove that you have another car to drive, and then you won't get hit with that lease. So there's so many quirky little things that loan officers who are good know what to do. So a great example of that is my clients were pre-approved for $520,000. I know I use this story a lot, but it's an amazing story because they sat down with a loan officer and literally showed them everything, and they only approved them for $520,000. Then I talked to him over the phone and I said, if you tell me these numbers, I'll calculate what I know you qualify for. And I got them approved at $585,000. Now what that did was that made it so that I could look at houses that were more than the houses they were looking at. And the thing that happened was one of the homes I looked at, and I always look in the area they're looking in, I looked at slightly higher prices because guess what happens? Sellers like to overprice their homes, which is the worst thing a seller could do. Did you guys just hear me? The worst thing a seller can do is overprice their house. So basically what happens, yes, you can use me as your realtor and you can use me as your mentor. That'd be cool too. I better say my license number because you just asked me to be your realtor. It's Sharon Suzanne Butler, 01018706. So that's my license number, and it's under my full name because I am a broker, so we don't have to pay another broker if you use me. Except for, yeah, exactly right. So anyway, back to the numbers. So you got your paper and pencil out, right? So, because I'm going to show you the easiest way that we basically look at the income. What happened was when I saw that they were approved for 585, I looked at homes where they were looking and the sizes they were looking at. There was one particular home that was priced at 585 that should have been priced at about 530. And so I decided to show it to them anyways. So what I do is I show the homes to my clients via Zoom. We actually go through the MLS together, the multiple listing service, and I show them what I'm searching. I narrow it down to 6 houses. I make appointments for those homes, and then we go and see them. Now, they didn't even want to see that one because they're like, it's priced too high. We can't have it anyways. And I said, but it's your dream home. Let's look at it, and then we'll talk about it. So we looked at the home that was 585. Now, before we even looked at it, they dropped it to 565. So when we walked out, I'm like, so what do you guys think? And they're like, of course we love it, but 565, we don't want to go higher than 550. And I said, well, let me comp it out. Because you guys as realtors and as people actually looking to buy a home, you might want to learn how to comp something out. Now, you can't exactly comp something out, but you can talk to your agent who can comp it out online and show it to you like I do. And so I showed it to them and I said, I think we're going to be closer to 542, maybe 548. Would you go to 550? And they said, well, maybe. I said, would you pay more than it's worth? Because I don't suggest to my clients that they pay more than it's worth. So what we did was I comped it out. I called the agent and I said, I have a question. We just showed your property. She said, yes. And I said, well, here's the thing. How did you get your price? And she started laughing really hard. And she said, I got my price because quite honestly, my seller doesn't want anything less than 552. If you can bring your clients up to 552, then we might have a deal. So we were able to make the deal happen because we were communicating. We got it for 552, but then the appraisal came in low. So when an appraisal comes in low, you got to renegotiate. You got to work on, how can we make, we were off by $22,000. How do we make that $22,000 come together? Well, in my head, we all worked together to make it come together. And that's what we did. But we would have never even got to that point if I didn't know, as a professional, real estate professional, how to see what they really qualified for. Because at 520, there wasn't really that many houses on the market. So if somebody underqualifies you, then you might not have the opportunity of a home that's right around the corner that you could have got. So what I want you to do is I want you to look at your income. So look at your pay stub, and you should have your W-2s also. So if you have your pay stubs and W-2s, what I want you to do is I want you to calculate your income. So I'm going to tell you how to do it, and then you can watch the video over and over and actually do it. So what I did is I was calculating the income, and there's going to be a big mess. My dogs are going to start barking because quietly coming in the door is my contractor that my dog hates. So we're live now and I can't do anything about it. And it's going to be this way for a few minutes. So here I go. I'm going to totally be thrown off. This is not going to be good, but I got to work with it. So let's say that you're making $19 an hour. So write down how much money you're making per hour. So I'm going to do $19 an hour to show you how it works, and you guys can write it down as you do it, and we'll go from there. See, I told you the dog was going to go crazy. He just doesn't like him. That's so sad. So take $19 an hour, multiply that, or your dollars per hour, multiply it by 40 hours a week, and 40 hours a week equals $760. Okay. Come down to Orange Beach. I've never even heard of Orange Beach. I'm focusing on the numbers. So if you really got to just text me or call me and we'll go. That's what I was going to do anyways, is I was going to offer anybody that watches this, if you want me to calculate your numbers for you, all you have to do is text me and tell me you'd like me to calculate your numbers for you. And what I need you to have is I need to have you to have in your hands your last 2 years. It's free. I'll do it for free. All you have to have in your hands is your last 2 years W-2s. And you need to know the biggest number on there. Also, you need to have your most current pay stub. So if you have your most current pay stub and your last 2 years W-2s, I can calculate out. The other thing that you're going to need is all your monthly debt. So if you have all your monthly debt, that will help too. So I'm going to walk through this one. I'm going to tell you how to do it. And if you need my help, all you have to do is call me or text me. My phone number is all over my TikTok page and all over my advertisements for my class, my cram course that I do every weekend, well, every other weekend and during the week. So, and I gave it out on the last video, and Arlene was going to kill me for giving it out. So all you have to do is find me on TikTok. It's SSButler8. And I'm sure that you'll find me. My phone number is all over the place. I give it to you, but Arlene's watching me. She gets very mad when I put it out there all the time. Anyway, all right, so take your hourly amount, multiply it by 40, and you get your weekly amount, which is $760. That's your gross income for the week. Multiply it by 4. Now, some underwriters will allow you to do 4.22 or 4.33 because there's more than 4 weeks in a month. Little did you know, right? So actually, they let you do 4.33. But you don't want to rely on that. So don't rely on that. Give me some thumbs up too, and follow me and like me and all that good stuff that we're supposed to ask you to do, and subscribe. That's what it is. Anyway, so then once you have the $760 a week, you're going to have times 4. I get $3,040 a month. Okay. After you get $3,040 a month, you take your spouse's income. Now, they don't have to be married to you. You can buy with your fiance or your girlfriend or your best friend, or you could have your parents co-borrow with you. But remember, if your parents co-borrow with you, if they have a house payment, that's going to count against them too. Okay. So we could talk about that if you want to talk to me directly about it. If you have parents, because parents used to co-borrow all the time, but they don't anymore. Probably because they still have house payments and other debts. Okay. So then what I did was I took the next person. Let's say that you have a spouse that makes $25 an hour. You take $25 an hour, multiply it by your 40 hours a week. Got that? Which equals, I got down 30/40. So they get no, I didn't. It's $40,000. It's God, I'm messing up. It's $4,000 a month. So you have one person at $4,000 a month, and you have one person at $3,040, and you add that together and you get $7,040. So this is the income. Okay. So you got $19 an hour times 40 is $760, and that's $3,040. Then you have $25 an hour times 40, and you get $4,000 a month. So you add those together and you have $7,040 a month. Okay. Now, how they calculate your debt ratios is what they do is different types of loans use different types of qualifying ratios. So what you can do is what I do is I pick up my phone and I say, what is the current debt ratios? You got those words, debt ratios? What is the current debt ratios allowed by Fannie Mae? And you'll get Fannie Mae's. Then you say, what are the current debt ratios by Freddie Mac? You don't need to ask for Freddie Mac and Fannie Mae. Freddie Mac will still follow Fannie Mae's lead. They're on the secondary market. They're the ones who make the rules that we have to follow for conventional loans. So conventional loans, the debt ratios are a little bit tighter, okay, versus FHA. FHA is actually very lenient on your qualifications, okay? I'm going to show you the difference. So on a conventional loan, which is Fannie Mae and Freddie Mac, conventional loans like to see a 38% on the front side, 38%. And on the back side, they like to see not much more than 45%. So it's 38 over 45. Well, how do I figure that out? Well, what you do is you take your calculator and you go 38% times 70/40. So you have 70/40. That's how much your income was. You multiply it by 38%, so times 38%, and you will get not very much. You'll get $26.75. So that income, see the income, 70/40 times 38%, you only qualify for a house payment of $26.75. Now that house payment of $26.75 includes your PITI. That's principal, interest, taxes, and insurance. And then if you have a homeowners association, that counts too. And right now in California, the homeowners insurance has skyrocketed because State Farm and Allstate are refusing to do homeowners insurance, or they're leaving California is what they're saying. So the California Association of Realtors is seeing what we can do about fire insurance and homeowners insurance, because you have to have homeowners insurance in order to close your deal. And if you can't get it, then you're going to have to get force-placed insurance, which costs a lot more money when you're a homeowner. Okay. So, At 38%, that's not very much. Then the other thing that we do is we take your debt, how much your debt is, and we're allowed to go up to 45%. Okay, so 38% is the front end. That's your house payment divided into your income. Okay, now that should be 38% or less according to Fannie Mae and Freddie Mac. However, let's say that you have really good credit and you have a little bit of cash reserves. If you have really good credit and cash reserves, they will allow you to push that 38% up to somewhere around 40%. So then you'll qualify for more. However, if you have debt, what you would do is you would take your debt and add it to that house payment of $2,675. So let's say that you have a car payment of $350 and your person who's co-borrowing with you has a car payment, and then you have credit card debts. Okay, so we can look at all that debt and see how we can reduce it so it doesn't cost as much against you on the debt ratios. So what we do is we take the house payment and we add all your monthly debt to the house payment. So let's say that we add all your debt ratio, your debt to it, and you add the debt up to 45%. Well, I took your income, took the income at 740. That's the income we're working with right now. It may not be your income, obviously, but take your income and multiply it by 45%. And you'll get a number. On mine, I get a number of 45%. At 45%, I get 3168. What's that say? It says, hello, how you doing? All right, so see that 3168? That's how much debt I could have. So in order to get that debt, what I'd have to do is take 2675. I'm allowed to go to 3168. So hang with me because I can't use my calculator. It's on my phone. And I'll tell you what kind of calculator I use. They should pay me for all the advertising I do for their calculator. It's called the Qualifier Plus. The Qualifier Plus calculates house payments for you. I can literally calculate your house payment in 6 seconds. I timed myself because 6 seconds is pretty fast. So 8, 9, 10, 11, 12, 13, carry the 1, 14, 15, carry the 1, 6. Wait, oh, I'm supposed to be subtracting it. Sorry, I screwed up. So 8 minus 5 is 3. And then, hold on, 0, 7, 16, that would be 5, I believe. So 2, that's a 10, 6, 7, 8, 9, 10. So I have enough room to have $453 of debt. And how I calculated that out was I'm allowed to have a house payment of $2,675 if I make 7,040. So I take my income, multiply it by 38%, I can have a house payment of $2,675. That's not very many house payments here in California, but I'm going to show you what FHA will do for you, okay? So with $2,675, that's the highest I can go on 38%. If I have debt, I can go up to 45%. So 45% of my income means I can go up to 3168. So I take 3168, I subtract out the house payment. That means I can only have $453 of debt. So if I have a $450 car payment and nothing else, these people will qualify on a conventional loan at $19 an hour for one person and $25 an hour. They would qualify for a $425,000 home. However, they might have to do it on FHA because on this particular loan at 38 over 45, let's pretend that they have really good credit and they have a 401k that they're not going to touch. It's going to be reserves because a 401k counts as your reserves. Isn't that cool? So what the Fannie Mae and Freddie Mac would let you do, because you have reserves and because you have good credit, they'll let you change that 38% up to probably about a 44. You could do 44 over 45. That means you'd have to have like no debt. So if you had no debt, you could be 44 over 44 or somewhere around 45% and still qualify, and you'd be able to buy a more expensive home, okay? However, I don't have an eraser, so I can't erase this part. I'm gonna tell you what FHA would do for them. So on FHA, they'd have to come in with 3.5% down. On conventional, they have programs with 3% down, and it's a first-time home buyer program. There's also programs out there that allow you 1% because they're dealing with a down payment assistance. So there's so many programs, and not all loan officers know about all the programs. So the first thing to do first is see how much income you have, how much debt you have, and then figure out what program you can do based on how much money you can come up with a down payment. Okay, there are all kinds of down payment assistance programs out there, but you have to qualify in their, you have to fit your box in their circle, okay? So sometimes it's not all that easy. So going on to FHA. FHA, you can watch this over and over so you can learn it. FHA will let you do 3.5% down, but on FHA, just like on conventional, you can get down payment assistance. Now, some of the down payment assistance programs, depending on which you qualify for, will allow you not to pay back the money you borrow. That's interesting. But the California Association of Realtors is trying to find programs that fit more people for the down payment assistance program. What they're trying to do is make it so you do pay it back so that more people can get more down payment assistance money, and it will cycle through and more people can buy homes. The problem is we need to build more homes, right? So on FHA, the same people that make $7,040 would on FHA they would qualify for $425, whereas on conventional they may only qualify for $300,000 because of the fact that FHA lets you go all the way. It's like 56.9% on your back end. And they let you do that because you qualify for more on FHA because they allow you to have a higher debt to income ratio. So debt to income ratio is how much debt you have and how much money you make divided into your income. You can go all the way up to 56.9% if you have good credit and you have reserves. Those are like the golden thing, good credit and reserves. Okay. However, the good credit thing on FHA is much easier, much lower than on conventional. So on conventional, it used to be that if you had a 740, you were golden. You got the best interest rate at 740. But if you had a 739, you were out of there. You got a higher interest rate. And this is how it works. You have two borrowers. You have a high score, a low score, and a middle score. We throw out the high score, we throw out the low score, and we take the middle score of the lowest score. So if your husband has a 780 and you have a 640, they're going to count the 640. Ouch. So then you're going to want to go FHA because FHA has better interest rates for lower credit scores than conventional does. So there's so much to know, and depending on if you use a mortgage broker has more availability at different lenders to see what you can do. So there's one company, it's called UWM, United Wholesale Mortgage. They're a wholesale lender. You can't go directly to them. So I can go to them, and if I have a self-employed borrower, I will not go to UWM because their underwriters are very difficult to work with when it comes to reading tax returns. So I would take my self-employed borrower to maybe Orion or maybe PRMG, different lenders that know how to read somebody who's self-employed. Now, if I have somebody who has a little bit worse credit, I'm not going to go to UWM again. I'm going to go to someone like Orion or Lonebridge who will allow for lower credit scores. So I know which lenders have which programs that have which credit scores versus, self-employed or not self-employed. So there's so much to learn, but the number one thing that you were supposed to take away tonight is the debt to income ratio. So basically, get your income and calculate your income. Multiply it. If you're going to go conventional, I would say multiply it by 38%, and that would be a comfortable house payment. Okay? Then what you want to do, thank you, I'm glad you're catching me live. You're going to learn lots of stuff from this video. It's a really good video helping you with debt to income ratios. Then what I want you to do is go ahead and take your income and multiply it, I would say by 45 to 48%. Do not exceed 50%. Stay under 50% for conventional loans. Now, once you do that, you can see, okay, how much can I really pay? Now, just because you qualify, here's the other thing. Just because you qualify, because I had one borrower, he qualified for an $8,000 house payment. I'm glad you trust me. I've been doing this. I was a loan processor first. So if you use any other loan officer, say this: have you ever processed loans? Because the best loan officers are the ones who first were processors. So I was a processor, then I got my real estate license and became a loan officer, and then I got my broker's license and started doing everything. training real estate agents and coaching them and all that stuff. So, and I walk you through your deal. And we're able to help people with their, the other thing that's really interesting is we like to make sure that you understand what's happening every step of the way and you're walked through it so you can understand what you qualify versus what you don't qualify for. But so anyways, what I was about to say before people started writing really cool stuff is we had a client that qualified for an $8,300 house payment. That's a big chunk, $8,300. So I told him that. He goes, but Sharon, I know we qualify for that, but that's stretching us and we don't want to feel stretched. I mean, they had like 5 kids. So I said, what payment is comfortable for you? And so just because you qualify for a payment doesn't mean you're comfortable with that payment. So the smartest thing you could do is tell the loan officer what you're comfortable with and then back it into the purchase price. Now remember, I'm going to give you a really great tax tip right now. Now remember, I'm not a CPA. I'm just a mortgage investor and broker. Now, I had my son who, we flipped houses together, and I tell this story a lot, so you might have already heard this story. But, without owning anything, his very first job where he actually got a paycheck was $125,000 a year. And he put 0 dependents, like many of you did or do. You have 0 dependents, and your employer has to take out for Social Security, Medicare, all that stuff has to come out. And they take as much as you allow them to take out because you have 0 dependents. Because you don't want to have to pay in February. You want to get some money back in February because maybe you want to buy new furniture or blow that money some weird way. Don't blow that money. Put that money aside for your down payment on your home. And then when you buy a home, you go to your employer and you change your W-9. You talk to your accountant who does your taxes and say this: when we buy a home, how many dependents should we put on our W-9s so that we get more money now so that when we do our taxes, we break even? See, you're letting the government use your money, okay? You're letting them use your money so that you can get money back. When if you change the amount of dependents, you get more money now so that you can afford the house payment that you're going to have. And then when you do your taxes, you're going to break even or get money back because you get to write off your $7,000 homeowner exemption. You get to write off some of the interest on your mortgage loan, and you get to write off your property taxes. By writing all those off and by taking more dependents instead of 0, you're going to be able to have a higher house payment and you're going to be able to break even on your taxes. Isn't that cool? So what happened with my son, I'll tell you what happened. It was so funny because he calls me. He's like, Sharon. I'm like, what, Blake? He goes, I just did my taxes and I have to pay the government like $2,600. And I said, well, what do you want me to do? He goes, I don't know. I go, why don't you ask your tax guy? His name's Tony. I go, ask him if I can give you one of my rental properties. Because if I don't, and in this year when he did this, we were allowed to do this. Now you can't just give somebody a property anymore when you've already paid it. So as a parent to a child, I was able to give him my property that was an investment property. Now there's a difference between an investment property and the one you live in. The one you live in, you can write off the homeowner's exemption, part of your interest, and all of your property taxes. You cannot write anything else off. But on a rental property is a business. So you have expenses. You have homeowners association, you have property taxes, you have maintenance and repairs, you have all kinds of things. So what I did was I gave that property to my son and I said, here, you can have it and you can use the tax write-off on it. And so I did. And so his accountant went ahead and did his taxes over, and instead of paying $2,600, he was able to get $2,600 back. So can you see the difference in owning property? The more you own, the more you can write off. But it does get capped out. So I notice that most of the time, depending on how much your interest is on the property, I would say 2, maybe 3 rental properties is going to cap you out on that write-off. But you still have an investment that's going to eventually be paid off. And then when you get older, you don't have to pay payments on it. You're just paying property taxes and homeowners insurance, and the rest is collecting rent. So I hope that all this information really, really helped you. If you have any questions at all regarding buying rental property, you can always contact me. The thing is, if you're going to buy a home from somebody who owns a home. Use a realtor who's actually gone through the process, who can take you through the process every step of the way. So at one point, I had 12 rental properties. I'm now down to 6. And at 6, I can see that if I wanted to, I could sell a couple of them and still have enough cash flow to survive. So I'm actually an investor. If you want to be an investor, learn from an investor. Don't take a class that you're going to pay money to and they'll tell you that they're going to help you. And then when you tell them about the deal, they're like, oh, that's not really a good deal. Or they don't really want you to keep or hold on to the property because they want to make their profit. I'm not here to make a profit off of teaching you. I'm here to help you build wealth and be able to help other people build wealth, because that's what we're all here for. So I hope that this video helped you. If you have any questions at all, feel free to contact me. I will give you my number. It is 714-745-6348. That's 714-745-6348. I'm going to tell you again, I'm a broker. My license number is 01018706, and I can answer all your questions regarding how you buy, how you sell. I specialize, I know this is going to sound really crazy, I specialize in first-time home buyers because I love weddings and I love first-time home buyers, but I also specialize in the 2 big D's, death and divorce. And I am probably one of the best persons. If you know anybody that's going through a divorce that owns property and needs somebody to help them, I am the person who's dead smack in the middle. I will not tell the husband what the wife says. I will not tell the wife what the husband says. I will work separately for both of them to come together, because sometimes when people go through a divorce, you know what they do? They each actually want their own realtor. And then the divorce attorney really can't, they can't refer somebody because they can't refer one person. So most divorce attorneys, if they have anybody to refer, they'll give you 2, maybe 3 business cards and say, try one of these. Well, what if the husband's attorney does that and the wife's attorney does that, and both sides try to find somebody they want to use? You're still stuck with 2 real estate agents. So that's like super crazy. Yes, again, my number is, so somebody missed my number, it's 714-745-6348. You can always watch the video over and rewind it and fast forward it and do all those things. So divorce, I am really good at, you guys. I've gone through 3 of them. 3 of them. So I know, and it was so funny because on the last divorce, I said to my husband, I said, look, during our marriage, we bought a house to flip. We live in a community property state. Remember, California is a community property state. Thank you for the blessings. I love it. So because it's a community property state and we bought a property to flip, I get half of it. Mainly because I found the house. I did the project management on the house. I listed the house and sold the house. I did everything. He got the loan. I did everything else. Okay, so we're married. We're in California. We were married when we bought it. We were married when we sold it. $97,000 is what our profit was. I get half, period. And I told him, divorce me now and I get half of the flip. He's like, no, it's under my name. I took it under my name. I go, yeah, you took it under your name fraudulently. He took it as a single man. I go, you weren't single when you bought it. All I have to do is show our marriage certificate. So I am an expert at divorce, tell me. So I told him, I said, look, the judge is gonna give me $97,000. This is how much I'm gonna get on this. And oops, by the way, you bought a car while we were married. So I technically own half your car. So I'm not a divorce attorney, but I know about the information on it. And I'm sorry, but California is a community property law. And now the other thing that you need to know if you're husband and wife and you're looking for a real estate agent to help you is you have to also know that you have to be logical and fair. And sometimes divorce, you lose your mind. I don't understand why people lose their mind, but they do. And you have to think logical, and you have to know that if the wife put down the down payment or the husband put down the down payment, and that money came from their original sole and separate property, and they can document it. So let's say that they put down $50,000 when you bought the house 5 years ago. They get that first $50,000 back. So if you have a profit of $250,000, they get the first $50,000 back, and then you split the 200. You each get 100,000. So you have to know how to do the money, and you have to have somebody logical like me that can show you the money and make it fair. Okay, so I specialize in divorce. The other thing that I said, double D's, I specialize in death. So hopefully a lot of you are prepared. I know it sounds weird, but you should always be prepared for death, and you should have a living trust. Having a living trust stops the deal from going through probate. Okay, you have a good night too. Stops the deal from going through probate. If you don't have to go through probate and somebody dies, then you have a living trust, you can sell the property right away. You don't have to wait for probate. That's the only way out of probate. A will not give you that. So again, I'm not an attorney. What you do is contact a living trust attorney or ask me, and I can tell you some of the people that I know and give you referrals. But you guys, I'm here to help you through all your life events and to help you know what you qualify for. All you gotta do is call me. I'm a text finger away. Have a wonderful evening. I hope that you learned a lot from me. And I don't know what the next lesson is going to be on, because I told you when we got done with all our lessons, you should be buying a home. So let's see how you can do it. Thank you, and have a great evening. Bye.